It has been an interesting time to be an investor these days. We're now officially witnessing the longest bull market ever, and recently there has become more chatter about a potential recession. This has contributed to the markets becoming more volatile with some wild swings this year. The one thing we know is the market hates uncertainty, and we've seen plenty of this as of late with concerns over the trade wars and talks about potential impeachment. Choppy waters like this tend to make investors nervous and more prone to making bad decisions. For most people, investment decisions are based on two very basic emotions, fear or greed. I have plenty of stories illustrating this, whether it's someone that invested all their money into Bitcoin when it was worth 15,000, or another client I had that sold all their investments in 2008 and has since refused to get back into the stock market. When making investment decisions, it's really important to consider what phase you are in during life. If you're on the left side of this peak here, you're someone that I would call in the accumulation phase. This is going to be someone in their 30s, 40s, or 50s, where the focus is still trying to accumulate and grow their wealth. Now, as you approach that peak, or maybe you're on the right side of that peak, your priorities shift and it becomes more important to preserve the money than it is to grow your money. Just by understanding which one of these two groups falls into will help you understand your ability to accept risk. The other part of this equation is to understand your willingness to accept risk. So for example, if you're someone here on the left still in that accumulation phase, just because you have the ability to be 100% stocks, maybe that's not the ideal portfolio for you if you're a conservative investor, as the investments may be too risky and might keep you awake at night. If you're someone that's looking for reasons to sell, the media is always going to provide that for you. What we see here on this slide is going to be different points throughout this bull market with some different highlights that we've seen, or some different headlines that we've seen from the media. Whether in 2011, a worse crisis in the US in 2008, Forbes magazine. Government shuts down budget impasse, New York Times. Britain votes to leave the EU, The Economist. What we see here, and what this chart helps highlight for us, is the difficulty it is as an investor to not allow emotions to cloud our better judgment. Because if, like I said, if you're looking for a reason to sell, the media has given it to you and you probably would have underperformed. But if you stayed in the market since the low of 2009, you could have had a return of 300% if you're invested in the S&P 500. The one thing we want to avoid is making decisions based on our emotions. We all know the old adage to buy low and sell high. The reality, though, is most people tend to do the exact opposite. They tend to buy high and sell low. What happens is people invest in things that they've seen have already made their money, or most of their money, and then the market's going to self-correct. It's going to lose money, and then out of fear and panic, they sell the investment, and people just tend to repeat this process over and over and over. As a result, what we've seen is the retail investor tends to have a much worse performance than professional money managers or the market overall, and this tends to be one of the largest reasons for that. So the question becomes, how do you make better investment decisions? I think Peter Lynch, who is one of the most successful investors of all time, answers this question with his quote, "The greatest destroyer of wealth is short-term circumstances frightening people out of their long-term plans." We want to avoid being an irrational investor. The best way to do this is to have a plan and stick with it. The easiest way to do this is by using the buddy system. I know for myself, I am most successful in the gym when I have a workout partner or a trainer to help hold me accountable to my plan. The same should be true for you and your investments. Whether the partner is a more experienced investor or a trusted advisor, by having one, you will greatly increase your odds of success. A successful plan needs to be a balanced plan. You don't want to become so conservative that inflation eats into your returns, and you got to account for the fact that you have a long life expectancy because people are living longer these days. It's amazing what medicine has allowed people to do. But on the same token, especially if you're someone in retirement, you need to consider maybe dialing back some of the risk because you'll have less time to recover those losses. And you're going to need to use that money to meet income needs either now or sometime in the future. And frankly, just by dialing back risk, they can help give you some peace of mind. So when you're putting your plan together, you want to balance both sides of these equations. Having a plan reduces the likelihood of you making bad decisions based on emotions. As we've already discussed, emotional-based decisions with finances is the greatest destroyer of your wealth. By having the plan too, it's going to help you feel more secure knowing that the market fluctuations are normal, and when they happen, you have a plan in place to help kind of guide that and deal with that. Now, the important part of having a plan is establishing it. The challenge, though, is most people tend to set it on a shelf and forget it. It's kind of a set it and forget it approach. The reality is that life happens. Your needs and your ability and willingness to accept risk are going to change over time, especially as market conditions change. So realistically, this plan should be updated and monitored annually. Thank you so much. If you would like to contact us more on this, please contact Paul Horn or Keith Johnson at 949-955-3203. Again, that's Keith Johnson or Paul Horn at 949-955-3203. Thank you so much for your presentation today.